An alternative investment is an investment that isn't considered core for your portfolio or a mainstream investment. So, for example, there are bonds, there's property, there's shares. They're considered conventional, traditional, they're mainstream. Alternative is pretty much everything else.
Right.
But
so meme coins, Trump coin, those
well,
sort of
they're
things.
extreme.
Crypto.
They're
Extreme.
extreme.
You're all over this,
Yeah,
Pete.
I've read
So
this.
you would concur that the mainstream traditional are the sorts of things that Roger just mentioned?
Definitely. That's the thing most of my mum and dad clients would invest in is their super would be in the share market, or they've got an investment property.
Yeah.
Most people know and understand property, shares, maybe bonds or a term deposit.
Yep.
Alternative is everything else that they are probably not as aware of or not as educated about, and probably need an expert to bring them into the tent and
So
discuss.
you check out Roger with Pete. According to Pete, thank you very much. You can continue.
The way I think about it is, if you're building a portfolio for your retirement, then the core part of the portfolio represents the hull of a boat. That's going to keep you afloat. The alternatives might be the outboard engine or the second outboard engine on the back of the boat. That gives you a little bit more oomph and can potentially enhance the returns of the main part of the portfolio. But because it's a smaller amount of money, it's not going to blow up.
Okay.
It's not going
to be the anchor on the boat. It's not going to sink the boat.
Not going to sink the boat. That's right.
Okay.
And so Pete jumped to a couple of extreme examples. What are less extreme alternative investments?
Well, the biggest one at the moment, and the one that I'd love to talk about, is private credit. It's been around for centuries. Lending money to other people or to businesses has been around a long time. 15 years ago, you had said, Roger, I want you to lend money to a small and medium-sized corporate in Australia. I would say that's an incredibly risky thing to do. Do not do that. And the reason why is the banks had pretty much stitched up that market. But after the global financial crisis, regulations were put on the banks about how much capital they needed for certain types of loans. And that made lending to small and medium-sized corporates in Australia much more expensive and much less profitable for the banks to engage in. The problem was, as the banks pulled back from that kind of lending, what happened was the demand for loans kept going up. And so now there's about a $400 billion gap between what small and medium-sized businesses in Australia would like to borrow for growth. And we're not even talking about the businesses that need the money to survive. We're not talking about turnarounds or businesses on the brink of collapse.
It's not an overdraft necessarily.
No, we're just talking about businesses that want to grow and expand because they're selling more stuff and they need to have a bigger premises or they need to employ more people or whatever it is. And so, they're a higher quality borrower. There's a gap between what the banks are willing to provide and the demand that's out there.
Why the gap?
Because the banks have pulled back from that type of lending. What's filled that gap, or what is in the process of filling that gap now, are what are called non-bank lenders. And you can now invest in funds, they're called private credit funds. What those private credit funds do is they allocate money to originators who then attract loans, review those loans, and then potentially accept and fund those loans. So there are investors now investing, and previously it really was the domain of large family offices, very, very wealthy individuals. But now you can invest in funds with as little as $10,000 and people are earning returns of 10% a year, circa 10%, 7 to 10%, with very high quality loan books, so AA or BB loan books, which is just jargon for a very high quality loan book. So very low risk of default or casualty, and receiving, so 7 to 10%, and receiving monthly income without any of the risk of the public market. So without that stock market volatility or bond market volatility. Now, there are risks associated with it.
It was starting to sound a little bit too good to be true.
Yeah, well, there are risks. Some funds, for example, lend to property developers, and they've been in the headlines at the moment because a lot of those developers have gone bust. And so the lenders have been left holding these unfinished properties, which it's going to take years for them to get their money back. But there are other private credit funds, and this is where you have to do your research. There are other private credit funds that simply refuse to lend to property developers. They don't do that.
Across your desk at work, are you seeing people investing in this sort of alternative investment?
I've got a few. Traditionally, they used to have to be what I would call my really rich clients would invest in that.
Sophisticated wholesale investors.
You had to have a certain amount of money that would turn up.
What did you call them?
Sophisticated and wholesale investors.
What did you call them? Really rich?
Yeah, I got to sign a form that says they either make a lot of money or they're really rich already.
Yeah, they would have had to have $2.5 million of assets or be earning more than $200,000 a year.
So it means they don't need as much.
Which is not me walking through the door.
As much due diligence.
So there have been people, that are doing that. Coming to see you, Pete. That was previous, but now there are more mum and
Well,
dad's.
there's more sort of a mum and dad way to access it is instead of my client needing to say, I'm going to lend to someone and I need to have the $500,000 or the $1 million or the $2 million to do it, they can invest in a fund with lots of other people who pool their money together to get that rate back. I think one of the things I have noticed about those funds in the past, I had a few clients used to do private credit, was getting your money back is not as simple as going to that transaction account and saying, I want my money back today. There might often be a bit of a window of time if you need your money back.
So there are funds, for example, that only pay, for example, quarterly, or they only pay, we're not comparing these to a term deposit.
Different. People have got to understand it's a different beast to a term deposit.
But if somebody puts their money in a term deposit for 5%, they're not going to receive their interest till the end of that 12-month period. And so some of the private credit funds are like that. So they'll only pay biannually or annually or quarterly, but there are others that pay monthly.
Yeah.
Is the reason that this is still considered an alternative investment somewhat down to, is there a lack of publicity about the fact that more everyday people can be involved in this?
So I wrote an article for The Australian last year, or the year before actually, predicting that in the next few years, this would actually become a new asset class.
It would move out of alternative into more mainstream.
It'll move out of alternative and it'll become more of a core element of people's portfolios. And that's because the demographics are right. So we've got this wave of baby boomers, and as they after retirement, as they approach their 70s and 80s, what we're discovering is that many of them are less accepting of the volatility of the stock market. So previously you had to have Brussels sprouts, and that was all you were served. And now guess what? There's a new vegetable, if you like. There's a new fruit that you can invest in that tastes better than Brussels sprouts, and people are saying, you know what, I need the income, but I don't want the volatility, and this might be the answer. Private credit might be the answer to that.
We've touched on, but not really gone into much depth here on Money, Faith and Finance into alternative investments, or at very least things like ETFs.
We talked about crypto.
And crypto, which like things that have bubbled up in the last couple of years, decade or so. But we haven't had much experience with them. But I think you know a bit more about ETFs than I do. Where I'm getting to is in this swirl of alternative investments. Pete, do you think this is sounding good where this private credit is rising to the top, possibly above ETFs and other alternative investments?
I think it's horses for courses. Definitely older clients who've probably already got their finances sorted and got money to invest and still got a bit of runway left, but are more at the 60 to 90 age bracket. Yes, they want income and they've got a pool of assets. Younger clients we've talked about here on the pod is, I'm trying to learn, I'm trying to get my feet in the investment world. An ETF can be a way to gain exposure to a market. I guess one of the challenges with ETFs is there's been a proliferation of them the last few years, and so many of them, even me saying to a client, you should think about an ETF, raises the question back from them of
which one?
Which one, Pete? You know,
how many are there?
Well,
thousands.
Thousands. You could have one over any niche investment you wanted. There would probably be an ETF for it.
So then what about in the private credit space?
Well, there aren't ETFs in private credit.
But in terms of private
like
credit,
different managers or different products.
Yes, different products.
There's a larger number of them offering private credit funds now than there were in the past because of its popularity. So it's really important that you find funds that have a long track record of success. You don't want someone who's just starting a fund and there's no track record. I think you might let them go for a while and see how it goes before investing. But there are funds out there now with 5, 10, 15-year track records. And they're the ones that you want to. The private credit fund that has operated through the COVID pandemic, for example, that will give you a better sense of how it will perform when times are a bit tougher. And if we go back to ETFs for a moment, it's asking about whether you should invest in an ETF. That's like asking whether I should invest in BHP or the Commonwealth Bank. They're so different, and at different points in time, they offer different opportunities. You can buy an ETF on Bitcoin now, bringing back two subjects that you raised in your question, cryptocurrencies and ETFs. You can actually invest in an ETF on a cryptocurrency. It doesn't mean it's safe just because it's an ETF. It's a cryptocurrency exposed ETF. So it will go up and down with Bitcoin. And Bitcoin's future is reliant on what we call liquidity. So central banks and treasury departments engaging in activity that floods financial markets with cash. That's when Bitcoin will go up.
What would make me not alternatively invest in private credit? Like, what would it be that would scare me about doing that?
There are some people who don't want to take any risk at all. And there is there is a psychological reason for that. There is a familial.
It's called being me.
There's a
I'm one of those
familial
people.
There's a familial element. But what I would say to those people is it's not a mutually exclusive thing. It's not I'm having all my money in cash or all my money is going into an ETF or all my money going into private credit. You can break it up. You can say, well, you know what, I'm going to put 5% in there. Yep. And I'm just going to dip my toe in the water and see how it goes. And that's a way that those people who are much more cautious can experience the benefits of investing wisely without feeling as though they've bet the farm on that entire experience.
Yeah. When you're pulling together people's tax returns, for example, Pete, are you seeing something like this tapestry of investment? Like, is it on the rise?
Yeah, definitely. We get our data from the ATO before the client even gives it to us. And I've got so many more clients that I will see the statements from 3 or 4 different ETF funds or a managed fund. Used to just be someone would have shares in the banks. So generally someone that thought they were diversified meant they had all 4 of the big banks in their portfolio and maybe a couple of the minors like BHP or Rio Tinto, something like that. But now, especially my younger clients, would be I'm in an ETF, but I might be in one over the US stock market, one over the Australian stock market, maybe a small companies. They would be, in their minds, spreading and diversifying by having 4 or 5 different managed funds. Not with big dollars in them, might be 5-10 grand in each one. But.
Look, for me, one of the motivators has always been the parable of the talents, and my responsibility to generate a good risk-adjusted return. And from that return, I can then do good things.